We are so happy to be in Philadelphia, and a big congratulations to all the Philadelphians in the region for your Eagles' superb win. I think it was Jeff who said to me last night, we're not losers anymore, so congratulations. You know, it's really a wonderful thing. And coming to the Philadelphia region is just a wonderful place. We purposely picked this to be located between Baltimore, Washington, and New York on the Eastern Seaboard. And I'd like to now bring up our host cities to say a couple words about themselves and also Philadelphia. So please welcome NAI Emery Hill, NAI Geist Realty, and NAI Mertz. Gentlemen.
Good morning. My name's Dave Grove. I'm the COO for NAI Mertz. And on behalf of the Mertz team and the teams at NAI Emery Hill and NAI Geist Realty, we want to welcome you here to Philadelphia and to the global market outlook. We did a little change up this morning and got together and thought we might spare you three succeeding, identical, welcoming speeches and just talk a little bit about our city and some of the takeaways you may have leaving here today. I'll just touch on briefly NAI Mertz, which is headquartered just across the river in South Jersey and has agents that cover South Jersey. They do industrial and retail work in the city and full service work up in the northern suburbs of Bucks County. And we also cover a wide area of geography on around the north-south I-81 corridor in northeast Pennsylvania. With that, I'll pass it on to Dean and maybe tell him a little bit about you guys and
Sure,
Philadelphia.
I'm Dean Geist, President of Geist Realty. We focus a lot of attention here in Philadelphia. Our office is 3 blocks from here, the western suburbs, full service. And that's the speech on Geist Realty. Between us, we have 75 years experience in NAI. I think that's a telling sign about the organization and how we feel about it. But I don't want to miss the people that are all in the surrounding suburbs here. So the Philadelphia surrounding brokers, stand up for me that are here, because they're an integral part of us. Where's Hanson? Where's CIR? Where are you guys? There you go. Stand up. These guys are all part of this Philadelphia network, and they're all part of the success of Philadelphia. So I wanted to thank them for being here and being part of the organization. I know you all want to hear about Philadelphia, and Comcast is building a tower, and Penn, probably the premier medical system in the country, is building a $1.5 billion office tower. But that's not the story of Philadelphia. The story of Philadelphia is we're 60 miles from the beaches, we're 60 miles from the mountains. We have an influx of people coming to live in Philadelphia. We have parks at Rittenhouse Square. We have parks down in this neck in the woods. Philadelphia is a livable, walkable city. We have history second to none. We have museums. We have the arts and the theater. And we have my age range people moving back in the city to enjoy the city. That'll help the city. It'll make it vibrant like it has been. We've added 40,000 new jobs in the city in the last 7-10 years. So this is a vibrant city. Anyone has any questions about the city or anything that any of us here can answer, just let us know.
Thanks, Dean. My name is Neil Killian. I'm with NAI Emery Hill, and I'm on stage today because I represent the southern boundary of our NAI territory here, which is the 4 counties to the south, and that includes all of Delaware and Cecil County, Maryland. We are considered to be the corporate capital of the world. We have over 1 million entities incorporated in our great state of Delaware. We're the home of tax-free shopping. We're the home of the Fighting Blue Hens. So we're really glad to be a part of this great territory, this great region, and thank you all for being here.
I do need to add one thing, or my boss Barry Mertz will probably chase me down and have my head if I did not touch on the fact that this region, if there would be a takeaway for you, is also a hub for logistic and industrial use. If you look at our metro area position on the Northeast Corridor, which is the most densely populated and wealthiest such region in the country, when you take a look at us being in the center there with a deep water port, great infrastructure of roads, rail service, and a generally low cost of living compared to our neighbors to the north and south, you can start to understand why our industrial specialists are as busy as they are. And we would certainly encourage you to seek out all of our team members that are out there today and learn more about the markets in which they work and how we might be able to help you in this region.
Yeah, thank you.
Okay.
Yeah. One last word. Go Villanova Wildcats. Let's go.
Thank you. Thank you very much. How about a round of applause for our host city? One of the things that we always try to do when we bring everyone together at our Global Market Report, we rotate this around the country. Last year we were in Dallas. The year before that we were in New York. The year before that we were in Chicago. And we're actually starting to think about where we should go next year. And we do that so you, the clients and the customers, can hear really great information about what's going on, and we always have to have a keynote great speaker that'll join us to give you some insights of where things are going. But I learned a long time ago, about 32 years ago, my second year in the business, that real estate brokers are great at making up things, but they're not that really great at predicting things. So we have engaged with Green Street Real Estate Advisors to be our econometric forecasting firm. And what I'd like to do now is introduce Andy McCulloch, who's the managing director of Green Street Real Estate Analytics. And Andy's going to come up and give us an overview on the market because they're the experts in what's going on in commercial real estate. But let me give a couple little things. Andy has led his coverage of the residential REIT for 8 years, starting in 2004. He's a featured speaker in the Wall Street Journal, Barron's, Forbes, Grants, the Financial Times. He's also a member of ICSC, the National Multi-Housing Council Partnership, the PREA, which is Pension Real Estate Association. He also is a chartered financial advisor. He's a counselor of real estate. He also has a BS and an MBA from the University of Southern California. Andy, we're going to let you talk about the market and tell us where things are going. Andy McCulloch.
Thanks, Jay, and thanks everybody for being here today. For those of you that don't know Green Street, just to give you a brief overview, we are a boutique research and advisory firm based out of Southern California and London. We've been doing this for about 30 years, have 160 employees. I think we are best known for the work we do on REITs or public securities, but we do cover all things commercial real estate related. What is a little bit different about us is we are independent, and we take that pretty seriously. We are not attached to a bank. We're not an investment bank. We don't have a commercial brokerage. We don't have an MLS platform. So really what that allows us to do is call it like we see it, both good and bad. So just to talk about the agenda for today, we'll give you a brief update on the macro environment, talk about what we're seeing with operating fundamentals, walk through trends we're seeing on asset values, and then give you what we call our commercial property price forecast. And I think that's interesting because we have been getting a little bit more bearish on what we expect for asset values, and we do expect asset values to fall here over the next 6 to 12 months, and I'm going to walk through why we think that. So just doing a quick backdrop on the overall economy. The economy is doing pretty well. Not great, but pretty well. And barring any type of trade war, hope that doesn't happen, economic growth is really going to pick up, we think, in 18 and 19. And it's going to pick up because you have these dual engines now of tax reform and deficit spending starting to kick in. If you look at this left chart, this is just job growth. February job numbers beat by a wide margin. December and January numbers got revised up as well. Job growth has been positive for 89 straight months. That's pretty good news. The right side of this chart is just consumer sentiment. Consumer sentiment is about at levels we haven't seen with any regularity since the 90s. So generally, people are feeling pretty good. This job picture hasn't translated into income growth yet. It's starting to, but it hasn't fully translated income growth. You probably hear CNBC all the time saying, hey, we're at unemployment of low 4%. We should be seeing better income growth. We do expect that to come eventually. But what's definitely going to help income growth is tax reform. I think there's a lot of concerning things going on in Washington. There's people getting fired left and right. You've got adult film stars going on 60 Minutes. So there's a lot of things concerning. But they did get tax reform across the finish line, and that's generally good news. It's good news for the consumer, it's good news for the economy, and it's good news for real estate in general. What this chart shows is just a change in after-tax income by state, and what you can see is all states are winners for the most part. At the individual level, 90% of individual taxpayers will be getting a tax cut this year. That's good for the economy. And I think the tax cuts on the personal side are much smaller than on the corporate side. So again, this is why the markets have been doing generally good since tax reform was announced. We have had a little bit of a pullback, but generally good. Investors are expecting an uptick in just general economic activity. If you look at by state, you can see that the bigger winners, everybody's a winner, but the relative winners are on the left-hand side. Those are these light green bars. Those are your low tax or no tax states. And they're the relative winners because we know with the repeal of SALT, some of your high state tax, high home price states, California, New Jersey, New York, were the relative losers. Pennsylvania slots somewhere right here in the middle. But generally, tax reform broadly is a good thing. A lot of the individual components of tax reform expire in 2025 to 2027, but the corporate piece is permanent, at least for now. So that's a good thing for the overall economy. So after-tax incomes are generally going up. That helps sentiment. What also helps is your average consumer is getting wealthier. So the two charts I have up here, left side is stock and bond wealth, right side is home prices. If you look at just general stock and bond wealth, as we sit here today, we're 50% above the prior peak, 50%. That's a big number, and that's great news. The only bad part about that is 80% of that stock and bond wealth is tied up with 10% of the households in this country. So we hear that a lot. You have concentrated wealth. But what's helping a broader swath of the economy is home prices, right? 2/3 roughly of households in this country own a home, and you do have home prices now just back kind of the prior peak and going past. We don't know what tax reform exactly is going to do to home values. I think if there was a relative loser in tax reform, it was single-family housing. But generally, things are pretty good right now, and home price growth is continuing. So generally, the economy's okay, not great, but okay. We are creating jobs, we are creating income, we are creating wealth. So I'd say the backdrop, the general backdrop for real estate is still pretty good. So what does the supply side look like? I think low supply, as you can see, we're on the right side of this chart, low supply has been one of the defining positive characteristics of this real estate recovery. As you see these light green bars on the right side, we're starting to get back to kind of a long run average, but we're far, far from overbuilding that we saw kind of in the 80s. So that's the good news. I think some of you that are in the apartment space, you might see pockets of overbuilding in certain markets. I think in senior housing, you have pockets of overbuilding. But as a general commercial real estate ecosystem, we are not overbuilt. I think if you look at the retail space, you almost have no new supply coming in, although you do have a bunch of shadow supply from retailer bankruptcies. And I think Toys R Us was the last of the old guard companies to announce they're going BK. So retail, no ground-up development, or not a lot of it, but a lot of shadow space. We're seeing a lot of new supply in industrial, but it's getting absorbed easily. So that's the sectors we'll talk about in a minute that's just really on fire. So supply picture is still pretty good. What's also a little bit unique about the supply picture at this point in the cycle is that it's been concentrated more in high barrier markets, your gateway cities. Kind of a strange irony. They call it high barrier, and that's where all the new supply is going up. But we do expect that to change, and as you look at new supply figures now, starts, permits, it's starting to spread out into some of the Sunbelt cities and low barrier areas where you can build. So if supply and demand are generally in balance, and we think they are generally in balance. What that means is you're going to get rent growth roughly in line with inflation on average, but it's going to be very different by individual property types. What this chart is, it's our cycle chart for fundamentals, and you've probably all seen some variation of this. It just looks at where the different property types are in respect to their own rent growth cycle. So we have a concept we call RevPAF, and it's just a combination of rent and occupancy growth. And what this chart does is it looks at our 5-year forecast versus the past 5 years, and where are we? And all these yellow bubbles are the different property types. I think a few interesting things here. If I'm on the left side of this chart, anywhere in the green, it means rents are still growing. But if you look at this chart as we publish it every quarter, what's happening is these bubbles are moving clockwise around the circle, and they've moved up into this top left quadrant mostly. And really what that means is growth is decelerating. So we're in the 8th straight year of positive rent and NOI growth. I think we are late cycle. I don't know how many innings are we going to go, or if it's a doubleheader, or what the case is going to be, but rent growth is slowing. Another interesting thing is just the dispersion. So usually when you track different property types and you go through economic cycles, the property types tend to move together. You have better performers and worse performers on the margin, but they tend to move together. What's really unique right now is how much the best and the worst property types are spreading apart. So the best performer right now is an industrial. It has the most gas left in the tank, and you're seeing all these retail subtypes move around this clock. There's something else happening in retail that's not driven by the overall economy, and we all know that's e-commerce. Industrial is a relative winner, retail is a relative loser, and it's causing this dispersion. So if you think about just the different subtypes of retail, we don't think brick and mortar retail is going away by any means, but we are over-retailed in the US, and some subtypes of retail are experiencing a lot of pain. So when we look at the different components of retail, we look at high and low productivity malls, and then neighborhood centers, community centers, and power centers in the strip space, what we like to call strip centers. Where the overbuilding or the over-retailed is going to get right-sized the most, we think, is in malls and in power centers. And that's where I'm the most concerned if I'm a retail owner today. If I own high-productivity malls and well-located grocery-anchored centers, I'm a little bit less worried. As you can see, those two subtypes, we still expect to see rent growth. Small rent growth, but we still expect to see some rent growth. What is happening across the retail space, though, whether I own high-quality assets or low-quality assets, is my CapEx spend is going up. What I mean by that is my capital replacements. So we think a lot of high-quality retail will survive, and once you get this bloodletting, if you will, and a lot of retail letting that die off, the stronger retail will be, or the better quality retail will be stronger on the other side. But redevelopment, re-tenanting, repositioning costs a lot of money. And this idea of maybe, hey, I'm going to get this big box back that pays really low rent, and I'm going to be able to jump up my rents, yeah, but to cut up that box costs a lot of money. So CapEx, the money I'm required to put into my retail assets each and every year to keep them competitive is going up pretty rapidly. So it's something to keep in mind. If you look at just what our absolute forecasts are as far as RevPAF, again, RevPAF is that combination of rent and occupancy. If you look at the left side of this chart, our growth forecast range from kind of -1% in some of the retail subtypes all the way to +4% in industrial. So big spread in expected rent growth. Again, you don't usually see spreads this wide. But generally, for most property types, things are still okay. Not as good as they've been the last few years, but still okay. The only place that I'm really concerned is retail. The chart on the right represent surprise indices. So we publish things called surprise indices, and really what they do is they track changes to our own forecast. So where do we see information or news that surprises us? And really what this tracks is, hey, if I have a reading above 50, it means I'm raising my forecast, and a reading below 50 it means I'm lowering our forecast. If I'm anywhere between kind of plus or minus 5 points around 50, it's not that meaningful. But in industrial, you can see we've been cranking our forecast. Every time we get new data, it seems to be better. We see this new supply rising, and it keeps getting absorbed, and rent growth keeps outpacing our forecast. And then in strips and other parts of retail, we've been slashing our forecast. It seems like every time we get new data, it's worse. So we'll talk a little bit more about this, what it means on the value side in a minute. But again, things are generally okay in most property types. Industrial's on fire, retail is pressured. So looking just about what we're seeing with asset values, slide here shows our commercial property price forecast. And all they do is they track changes to asset values. You've probably seen these from NCRE, for Real Capital Analytics. Everybody's got their own indices. Ours are a little bit different in that they're asset value weighted, so there's a higher percentage of institutional quality assets and the gateway markets in here. And they're also not based on repeat sales. And what I mean by that is these are set by our team of 50 or so analysts talking to owners, operators, brokers in the market. Where are deals getting negotiated today? If something was getting negotiated today, where do we think the values are? The reason why repeat sales can be dangerous is they're stale, right? And in the moving markets, they can be up to 6 months stale, right? By the time a deal gets done, it could take a while to get reported, and even after that, when that deal got closed, it could have been negotiated several months before that. So we want to try to get our read on the market as close as we can to real time. The interesting part about this is the right side of this chart, excuse me, because a lot of the other indices out there aren't showing what our indices are showing, and it's a pretty wide spread in performance by subtype. On average, we think asset appreciation has largely stopped over the last 12 months. Very little appreciation in aggregate. Those are kind of the light green bars, if you can see them. But if you look at the bar chart on the right, this is performance by property type, and we think industrial and malls have moved apart from each other 20%. Values have moved 20% apart in the last 12 months. That's pretty big moves. And I'd say last night there was a big announcement. GGP, General Growth Properties, big mall company, is getting acquired by Brookfield. It's getting acquired at a value about 15% below our carrying values, 15% below NAV. If you unlever that, it could mean that mall values are down another 10% from what we show here, right? So definitely some pain in the retail space. If you look at some of the niche property types, student housing, manufactured housing, data centers, performing actually quite a bit better than some of the major property types. A lot of bubbles on a chart. What does this represent? So these just show asset appreciation for kind of a baker's dozen of key real estate markets, West Coast, East Coast, some of the Sun Belt. The color of the bubble is the property sector. What we find interesting here is, you know, especially on the investor side, people spend a lot of time about market selection. Where should I be? What's interesting here is, yes, the West Coast has performed a little bit better over the last 12 months, but the takeaway here is it's all property sector driven. If I look at the top, it's mostly industrial. If I look at the bottom, it's mostly retail. It means the property sector is driving fundamentals much more so than any type of geographic positioning. Industrial is the best performer on this chart in every market except Houston, where it shows apartments is the best. It's kind of misleading. Industrial is still the best performer in Houston over the last few years. It's just that apartment values, when oil corrected, got hit really, really hard, and now they're bouncing back a little bit. But it's very interesting here. So again, we as researchers spend a lot of time working on market selection for our clients. If you miss sector selection, you're going to lose, especially in this cycle. Just a quick comment on cap rates. We all talk about cap rates. Cap rates are a funny thing in the real estate space because everyone's got their own definition. Ours is nominal, so pro forma forward 12-month income before any type of CapEx reserve. The takeaway here is just this bottom right of this chart. We do believe cap rates have started to inch up. Not dramatically, but for the most part, we do believe they started to inch up. Why is that? Well, bid-ask spreads are widening out. When we think of values, we mark to the bid, right? If I got to go sell something, it's the bid is where the true value is. I think generally investors are just more cautious today. They do see slowing fundamentals. They're worried about the Fed raising rates, even though I think there's too much focus on what the Fed does. And all this has created some choppiness in the market. Transaction volume is down slightly. I think transaction volume would be down a whole heck of a lot more if the lending environment wasn't so accommodative. I think debt markets are still very much functioning for most property types, with the exception of some low-quality retail. Even construction financing has opened up a little bit. So the debt side is still pretty healthy. Not to be too negative on retail, but it's where numbers are moving in the most. So there's two charts on the slide here. One are changes to cap rates in malls. That's the left side. And in the mall space, everyone talks A quality, B quality, C quality, and how that's usually defined. There's a lot of things that go into grades, but it's mostly sales per square foot. So the bars represent sales per square foot and the associated grade, and there's two rows of bubbles that you see on that chart. The green bubbles are where cap rates were at the end of 16, and the red bubbles and the arrow up are where cap rates are today. And you've seen cap rates blow out significantly for low-quality malls. Malls are unique in the world of real estate as you go down the quality spectrum because investors believe that certain low-quality malls won't survive. So what that means is cap rates go really parabolic as you go down the quality spectrum. And back to my point about GGP, if you look at this chart, if you go into the higher quality ranks, A++, A++, really fortress regional malls, we haven't moved our cap rates that much. This big GGP news that just happened suggests even our high quality mall cap rates are probably too low, and those will get marked. There's a lot of moving pieces when a company is taken private, and it just got announced. We'll look at it, but it doesn't look like a great mark for retail value, so we'll look at that a little closer. Chart on the right, it's a different representation of changes in cap rates, but all this is strip centers, so this shows strip centers between your neighborhood centers and your power centers, and then by market, and my primary, and my secondary, and tertiary. At least our intelligence, us talking to people on the ground, there's been pretty big movement in power center values over the last 12 months. We've moved, if I own a secondary or tertiary power center, we think cap rates are up 200 basis points in the last 12 months, so a pretty large move. If I own well-located primary grocery anchored centers, you can see there's almost been no move, at least from what we can tell, on cap rates. And I know the Amazon Whole Foods deal was eye-opening and have people worried. You know, is grocery the next food or next shoe to drop? We don't know. We're holding off on that. But for the most part, grocery anchored is held up pretty well. All right. So next and last section, it's the bigger section, but I think it's the most important. Where do we think values are going to go? What's our commercial property price forecast? How Green Street looks at the world and how we come up with trying to estimate where values are going to go. We look at how real estate is priced relative to the bond market, specifically corporate bonds. So I look at expected returns on real estate and yields on corporate bonds. And I also look at the public market, REIT market. I look at the REIT market because it tends to be predictive of private market value. So I look at corporate bonds and I look at REITs. The first step at looking at expected returns is building them. So we have to estimate what expected returns are. And if you think about how I build those up, it's pretty much what's my cap rate minus my capital replacement reserves plus my growth. The growth is always the hard part to estimate, but that's how I build an IRR. It's a little bit about different. If you guys see Green Street research, is our IRRs are always unlevered and they're perpetual. It means I'm buying a piece of real estate and I'm holding it for a very long period of time. Call it 50 or 100 years. Not a lot of real estate's held that way, but why do we assume a perpetual IRR? Because it allows me to sidestep exit cap rates, right? What's an exit cap rate? Plus 50, plus 100, plus nothing. I don't like that math, so we assume I buy something and I hold it for a very long period of time. Today, on average, I'm getting about a 6. There's a lot of difference by property type, but when I buy commercial real estate today, I'm getting about a 6. What tends to jump out in our underwriting when we look at the commercial real estate world is, wait, you're predicting long-term growth of 1.3%. That looks pretty terrible. Why is that? Not that real estate's a bad asset class by any means. It's just one reason it's so low is inflation today, right? So if I look at inflation expectations, we're around 2%, just above. If I'm normally getting high 2% to 3% in most of history, and now I'm 100 basis points lower, well, you gotta reduce your forecasts when it comes to rent growth. We're in a low inflationary environment. We don't forecast inflation. We look at the bond market and specifically TIPS. So Treasury inflation-protected securities. You can impute what the market is expecting for inflation, and today it's low 2%. You can't see it on here, but it's missing one of the labels. You have seen an uptick in inflation since the election, but again, it hasn't gone crazy. And I think all the positive commentary I made on tax reform and the economy getting better, that's all true in the near term. But tax reform is still deficit financed. $1.5 trillion is the bill for that, and what that's going to do is going to suppress long-term rates. Any type of study that you look at, the more indebted a nation, the slower growth in the out years. So tax reform is a great thing, probably for the next 5 years. It's going to hurt us pretty big in the long term, and that's why you've seen the yield curve flatten out. You have the Fed pushing on the short end of the curve. You've got deficits pushing down the long end of the curve, and that's what's causing things to flatten out. Second reason that our long-term growth rates might be lower than people underwrite is you have to, when you look at reported growth, whether you're looking at the public companies or NACRE for different things, you have to strip out redevelopment, you have to strip out adding square footage, and you got to strip out all the games companies, especially the public companies, play with the same store pools. So growth is lower than I think a lot of things you read. The other thing that we adjust for, and this is very topical these days, are disruptors. Airbnb, e-commerce, driverless vehicles. All these things are going to change the way real estate performs in the future versus how it has in the past. Now, you're probably looking at this chart and saying, man, there's a lot more red arrows than there are green arrows. Why is that? Well, in real estate, if I get a positive disruptor, something that increases demand for my space, developers will quickly come and build. They can quickly meet that demand. If there's a negative disruptor, like e-commerce, that reduces demand for space, we're not knocking down shopping malls nearly as fast as we should, so it's a lot more painful to rent. So that's why there's more red. As we sit here today, the biggest disruptor, as we've talked about in retail, it's e-commerce, and it's not even close. It's the biggest disruptor by far, and we're probably in the third or fourth inning when it comes to that right sizing. Again, we got to get rid of a lot of retail that we don't need. But as you saw before on the cycle chart, it's very different depending on what type of retail that I'm in. So if I look at this is just kind of our e-commerce impact on the different property types. Industrial, way to the left, big green bar. And as I go down, I did this on a Mac, so you can't see. So this is, for some reason, screwing this up on the screen. But I'll walk across. You've got industrial, then high productivity malls, then neighborhood centers, then community centers, then power centers, then low productivity malls as I go down. If you think about the difference between a high productivity mall and a low productivity mall, you're talking about 5 to 6% difference in growth per year, right? So that's 30% that rents are going to diverge over a 5-year period. That's why you're seeing cap rates gap out so dramatically in the private market, because investors are seeing this happen. High productivity malls, they're going to require more investment, but we have every belief that they're going to survive. I think retailers want space in certain high productivity malls for brand awareness, to test out new concepts, for all types of different things, and they'll pay rent that isn't justified by the sales out of the store. So we think high productivity malls will survive. The thing we get quoted about a lot from our retail analysts, there's 1,200 malls in the US. We think 300 die in the next decade. We think another 300 die in the 10 years after that. So half the malls in this country are probably gone in the next 2 decades, or something else, right? Community college, industrial, something different. But we do think a lot of those will go away. Talking about other technologies, driverless vehicles. This is a polarizing topic. You know, I think that the impact on commercial real estate when it comes to driverless technology doesn't really happen until you have mass adoption, right? Because you're going to see more and more cars on the road, but the impact, lower traffic, improvements to safety, less traffic accidents, all those things, higher productivity, really happens when you get to a point that you start outlawing human drivers on certain roads. I think we're pretty far away from that, maybe 10 to 15 years. But we do believe the impact is going to be pretty massive once we get there. The hurdles won't be the technology. For those of you anybody drive a Tesla, a newer Tesla? Anybody in the room? Pretty amazing, right? What the car can already do. So the technology, we're actually pretty close. I know people they probably read about the accident that happened with Uber. I think it was in Phoenix, where a pedestrian got killed. I think that's not going to have a material impact on slowing this down. It gets a lot of press. But that was one fatality. There were 6,000 fatalities to pedestrians caused by human drivers in the last year. So I think it's make a lot of headline news, but I don't think it's going to slow it down. What I do think is going to slow it down is Americans have a very strong car culture. You've got 3 million jobs, 2% of the U.S. workforce that drive trucks and taxis. We need some social safety net for them. And then security concerns. When we talk about driverless cars, it's not all of us having our Teslas. It's some new breed of car, whether it's Tesla or Lyft or GM or Ford, where all the cars talk to each other. They talk to the infrastructure, talking to the streetlights. That's a system, think about airline systems which are closed. That's something you need to protect. And so that I think will be the delay. Once you get there, what happens to real estate? Which commercial real estate sectors get impacted? I talked about this the last time I spoke to your group in Southern California. The biggest impact is self-storage. And why do we think that is? Because if your average household can go from 2 cars to 1 car to no car, they get all their garage space back. and there's 10 times the square footage in US garages than there is institutional quality self-storage. You won't get all that back. A lot of garages are already filled with junk. People might make them guest rooms or offices or different things. But the sheer magnitude of all that square footage, if people start getting rid of their cars, is absolutely massive. There'll be impact to parking, right? You have 1 billion parking spaces in the US, 4 for every car. You're not going to need that much anymore. I think there'll be impact to transit-oriented development. People, transit-oriented, it's a buzzword. I want to be next to the train station. I'm going to pay a rent premium. I'm going to pay an investment premium. And today, I think that makes sense. But if you have widespread adoption of driverless cars that can take me into the city, I don't necessarily need to be by the transit stop. So those premiums will probably shrink over time. It also means the suburbs will be a relative winner. And a relative winner, especially places like where I live in Southern California, where there's no public transit system. So people don't want to live in the Inland Empire if they can live in Orange County because they don't want to spend 3 hours in the car every day. It's stressful. It's non-productive. But if I'm in a driverless car, I can eat, I can sleep, I can do my work. And if it's widespread adoption, it will be faster. So in areas without public transit, I think driverless cars are going to have a big impact on the suburb. Been beating up malls pretty good today, so I apologize about that. Malls will actually be a winner in driverless cars, we believe. This bottom right chart, if you can see it, is just an aerial view of a mall. What do you see? A lot of surface parking that you don't need anymore. So you can densify the mall, you can build apartments, you can sell it off, out parcel, whatever you want to be, but we do believe malls will be a relative winner there. Last topic just on disruptors is co-working and WeWork, something we look at a lot. And the question here is, what is the impact going to be on office demand? So this is a relatively simple analysis, how we look at it. So it's competing forces. WeWork is about competing forces and about who's going to win. Can the co-working companies bring independent workers into the office? Can they bring people out of the Starbucks, out of their home offices, into office space faster than your enterprise users are downsizing, right? So your enterprise users are saying, hey, WeWork is actually pretty good at this. I'm going to outsource my office space to them, and what that usually means is densifying, so they're taking less space. So that's the competing force. And how we look at that is we probably think you end up somewhere in the middle, just below even. So we think that the densification of your big corporations will outpace bringing all these people out of the Starbucks, but only slightly. So we look at WeWork, a 2 to 3% demand hit over a very long period of time, call it 10 plus years. That's almost a rounding error. So for the most part, WeWork, at least as we sit here today, far less disruptive to the future of office than e-commerce and eventually, obviously, driverless cars. How much time do I have? We're good? Okay. So back to the commercial property price forecast. These are our expected returns. Some of these things are a little bit screwed up again from the Mac. I apologize. But we're to 5.9 today, just under 6% on expected returns. This is our series of expected returns going back all the way to the 80s. We're about pretty close to as low as we've ever seen. That's really not all that concerning to me. We're in a low return world. We always want to look at expected returns on real estate relative to something. We look at corporate bonds, and we look at corporate bonds, and that's what this chart shows, investment grade and high yield. We want to see how the fixed income market is pricing risk. That's why we look at corporates instead of treasuries. And really what we want to look at is the spread. So as a real estate investor, when I buy real estate, I usually get, over time, about 150 basis points of extra spread by buying real estate versus investment grade bonds. That's almost exactly what I'm getting today. What that says is, I don't know where we are necessarily in an absolute sense, but investment managers have to put money to work. And if I'm deciding we should real estate versus corporate bonds, I'm roughly at parity. They both might be inflated, but again, they're about fair relative to each other. If I look at junk bonds, an investor is usually willing to accept slightly lower return for real estate than junk bonds. I'm sitting within spitting distance of what's been happening all the way back since the late 90s. So again, real estate, at least versus corporate bonds, looks pretty fair. A more ominous signal, though, and that we pay a lot of attention to, is the public market. REITs, are they trading at premiums or are they trading at discounts? We look at that because they tend to be predictive. So what this chart shows, this dark green line is premiums and discounts in relation to asset value, where the REITs are trading, and the bars are subsequent, so lagged, 6-month changes to asset values. And what we're doing is saying, hey, is the public market predictive of where the private market's going to go? More often than not, it is. And like I said, we just saw a big trade on GGP, and the mall company has been trading discounts for a very long period of time. This gigantic mall company was willing to sell all its assets at a big discount to at least where we thought asset values were. So the public market, in that sense, was right, and asset values have been falling. But this is for the major property types. So if I look at where I'm trading by sector, I think this chart's interesting. So the left side of this chart are the major property types: mall, strips, office, apartments, industrial. Every single one of them, with the exception of industrial, is trading at a discount. So the public market is saying asset values are going to fall. On the right side are your niche property types: student, healthcare, storage, manufactured homes, net lease, data centers. And there's a bunch on here that's not on here that we cover. A lot more of the niche property types are trading at premiums. So something the public market likes, some of these emerging property types. Either they believe that cap rates will continue to compress, or NOI growth will be better. Whatever the case may be, the public market is pretty bullish there. If I was buying assets today in the private market, if I was putting my own money to work, this is where I'd be putting it. I'd be putting it in the niche property types. I think they have better expected returns, and the public market is saying that's where I should put my money. This is probably the slide of the day. I think it's timely. So this is M&A activity. And this line with the bubbles is Green Street's forecast for M&A. So we look at public market premiums and discounts. And whenever those discounts get real big, there's a disconnect between public and private market values. And usually when that happens, you see M&A activity. So the line is our forecast. The bars are actual M&A activity. And why I put this chart in here is you can see the far right side of this chart, we started to see our M&A probabilities tick up again. And what you're going to see tomorrow is a $25 billion bar inserted here for GGP. So we always look at it when the public market discounts get real big, you see M&A activity, assuming the GGP deal closes. So just tie all this together, and I'll take some questions. This is our property price forecast. So real estate looks roughly fair versus bonds. It looks pretty expensive versus what the public market is telling us. That's why this arrow kind of is looking down. Not dramatic, but over the next 6 to 12 months, we do expect to see a slight correction in values. How that plays out in reality is we think cap rates continue to inch up and be partially offset by NOI. NOIs are still rising, net operating income still rising, but not up enough to offset the move in cap rates. I think I'm getting yanked. Have time for a few questions?
We want to move on.
Okay.
We want to get to work.
Okay, great. Well, thank you very much. I appreciate it.
Thank you. We're very sensitive to everyone's time in the room, so that's why we want to move to the next section. But thank you to Andy. This whole session, including his presentation, was being videoed. And so everyone, we have all of your emails, so we will be distributing the video for your pleasure to watch that, et cetera, so you'll be able to see that. But without further ado, I'd like to ask Fred Meyer and our keynote guest speaker, Philip Mintz, to join me on the stage, and we'll get into a conversation of where the real estate markets are going. Gentlemen.
Thank you, Jay. My name is Fred Meyer. I am the Director of Corporate Services and Head of Brokerage for NAI Mertz. We are very proud to be the sponsor for this section of the Global Market Outlook, and introducing Philip Mintz to everyone. Philip is the Partner and Chief Investment Officer for Apollo in investments both for the United States and Asia, and he will give his thoughts on the market where we are now and where we are planning on going. And I will contradict Jay on one thing, that I will make a prediction, and it'll be a good real estate broker prediction, that everything that Philip says, I will repeat in my future presentations, so there's no pressure on you to be right, which I know you will be. With that, I'd like to, Jay, do a quick little introduction as to who Jay is. He's the president of NAI Global. For those of you who are not members, Jay has done a great job keeping all of our entrepreneurial brokers and type A brokers focused in order to increase the amount of business that we do amongst ourselves and also corporately around the world. Jay, you want to do a quick introduction as to who you are and your background?
Absolutely. Well, thank you, Fred and Phil, for being here. I'm actually in my 35th year of being a commercial real estate broker, and I do consider myself a commercial real estate broker. I started a long, long time ago on the streets of Washington, D.C., so I do consider myself a street broker at heart. I consider myself an office landlord broker. That's what my specialty always was. But I moved into the management ranks in about 1994 full-time. I was with a small company called CBRE in the Washington, D.C. market, and I spent about 15 years there with CBRE, and I ran all the different operations from property management, investment sales. I was a management weenie at that time, or as Fred's like to say, I was herding all you cats out there as far as brokers. So I consider myself a fairly good expert in running a brokerage business, and I'm thrilled in 2011, really when Jeff Woodward, our chairman, and Frank Garrison, and ultimately Andrew Farkas gave me a call and said, we think you can run this company, come run it, and it's been a wonderful opportunity since then. It's allowed us to be on a global stage, it's allowed us to be on a national stage, it's allowed us to have wonderful guests like Apollo and others that join us, and so I consider myself a pretty broad view of the commercial real estate business, which we'll touch on, and just glad to be here. Thank you.
Thank you, Jay. With that, I'd like to introduce Philip. Unfortunately, Philip was a graduate of Duke, and they did not make it to the Final Four, and that broke one of my brackets. So I thank you very much. We commiserated as the last minute or two. We thought that Duke was going to do it. No disrespect to Villanova, but I did have Duke beating Villanova. So Philip, you want to tell us a little bit about your background before you got to Apollo, how you got to Apollo, and what your current role is?
I had Duke losing to Michigan State.
Okay.
So that tells you how much I know. Sure, my background, I started early in my career as an attorney at Skadden Arps in New York. Then I was a real estate banker for about 8 years. And then in 2001 or 2000, my client General Electric hired me, and I did some large transactions for them, and ultimately moved to Tokyo to run their business in Asia. So I did that in 2001, and then I started Warburg Pincus's business in Asia, which is another financial services firm like Apollo. I ran that till 2010. Then through a confluence of events, I started my own business, which was a Chinese development fund where we had about 150 limited partners and $1 billion of assets that was very dysfunctional. I restructured that and sold it to Apollo, and now I run Apollo's real estate equity investment. That's how I got to Apollo, and I run the U.S., I run the Asia, and I'm also on all the investment committees for all the stuff we do in debt and equity around the world.
Great. And how much interaction do you have with the different Apollo businesses? I know we're at the home of Philly with the Sixers. Is not a true Apollo business, but somewhat affiliated. Yeah. So you have to trust the process for those Sixer fans. I'm a Knicks fan, and it's killing me, but.
Yeah, no,
how much interaction?
We have a lot. I mean, I found the last discussion fascinating, you know. I mean, you see those charts and you listen to it, and I often follow economists when we see some of our investors, and it's very humbling because it sounds so great, but then it's very hard to put that into practice. And the way we try to put it into practice is by being pretty integrated around the world. I mean, we see transactions across both debt and equity, you know, basically every major city in the world, and we relatively price things, whether it be our structured credit deals, whether it be our equity deals, to get as much understanding. I can give you examples in healthcare. We own hospitals. We lend a lot into the senior housing communities. We are now doing an equity deal in that space. Manufactured housing, we lend, we chattel finance. We also own manufactured housing communities. So we try to be pretty holistic in our approach and fairly integrated, because for us, it's all about information advantage. And because the same Green Street presentation, which was phenomenal, gets distributed pretty broadly, and I'm not so sure how predictive it is as much as it is historical. And guys like us try to make money being more predictive. And so it's a little bit of a different discipline.
Speaking of predictions, what are the hotter markets, both globally, city-wise, and as far as service platforms? I know that's a softball.
We actually look for the cold markets. I mean, again, that's why I mentioned those charts, because I find them fascinating. I mean, when a market is hot, that generally means that cap rates have compressed massively, which means that for people like us, it's not the time to buy. So if you look at the things that we have done recently in the United States, for example, in 2011 and 12, we bought a lot of single family for rent, which was proven now to be the right time to buy. A lot of people are doing it now. We're sellers. Manufactured housing, we actually bought a $400 million platform last year. But we like it for many of the reasons that weren't really expressed on that particular chart. The reason we like it is on pure relative affordability and the fact that there's net negative supply. So I know that Andy spoke about supply. There's actually decreasing supply in an asset class that's very disaggregated. So we like manufactured housing. We also like senior housing. The reason why we like senior housing is because there's a lot of perception versus reality differences. You know, people perceive senior housing as oversupplied. They view it as public pay, et cetera, and materially oversupplied. And when you really boil it down, the oversupply tends to be very concentrated in certain geographies and certain types. And so we found niches where we can actually make, you know, pretty sustainable money, much better than the charts would imply. So we tend to look for things that are actually out of favor. You know, we're doing a big retail deal in the next few weeks, almost $850 million, you know, which would be very contrary to some of the charts. So I'd say we actually look for the cold things more than the hot.
So when you're looking at that retail deal, would you be looking at it from a pure retail play or a repositioning play or a little bit of both?
Pure retail.
Pure
yield.
retail. Okay.
Yeah, I mean, there's great stats. I mean, if someone said to you 25 years ago that there was another means of retail other than physical retail, and it accumulated to 10% of retail sales, do you know what that would be?
25 years ago?
25 years ago.
Yeah, that's a good question.
Catalogs.
Yeah.
Today, e-commerce is 10% of retail sales. So, you know, our view on retail is that it's a little bit oversold. It's a little bit, kind of out of favor, and we're pretty bullish on certain segments of retail.
Interesting, because you know we've had in past events like this, we've had some high data people talk about that. You know, it's like 7 to 10% now. But what happens if it goes to like 19 or 15? You know, does that? You know, we both live in New York City. Fred's from New York City. Certainly, the e-commerce effect on New York City is huge, both on the industrial, the retail. You know, it seems like, and also just supplying the entryway to my apartment building with boxes is something. So, do you feel if a retail sale, let's say internet sales were to dramatically increase, that it would have more effect on brick and mortar?
Yeah, I just think that people overreact and exaggerate. You know, industrial is so hot now because it's the inverse of retail. You know, we just sold an industrial portfolio to one of our competitors at a sub 5.5 cap rate. It makes no sense to us.
Right.
You know, it makes literally no sense. The weighted average lease is about 8 years on that portfolio. There's generally no growth left in it, and yet people are chasing it like you can't believe. And I see that around the world. The same dynamics happen in China. They happen in India. And from my perspective, one of the things that was missing a little bit in the presentation is that, you know, when we talk about what's a hot space, it's all capital flows.
Right.
And the part of the problem is that too much capital is chasing too few ideas. And the same thing is that some of that capital is going away from concepts that actually I think make some sense. And that's dislocating prices in meaningful ways.
Yeah. Speaking of your experience that you've had in Asia Pac in particular, there's been a lot of change in the last, let's say, 12, 24 months, certainly China-based, et cetera. You know, what are your thoughts on, you know, 2 years ago they were buying everything, and now they're kind of buying nothing, but you're probably more expert in where that's going.
Yeah, I think, you know, you saw that with the Australians 10 plus years ago.
The
You know, Westfield came here and they owned a lot of the retail. Various other vehicles were raised in Australia. They bought tons and tons of retail. I think that the Chinese have, you know, I'm very bullish on China personally. We invest substantially there. I think I must have invested $2 billion there in the last 10 years of equity. And, you know, I think that the Chinese got a little excited. They started, you know, it's a state-controlled economy. The banks are state-controlled. So basically the capital flows very fluid and very quickly into specific places. And so you have a couple of, you know, HNA and other kind of big corporates that went in crazy buying sprees. I mean, insane. Eastern Europe, the United States, all over the place. Australia is a massive, I mean, they have literally moved the Australian markets materially. You know, I think that was episodic. I think that's not going to continue. The government has clamped down substantially. They're now net sellers. Unfortunately, they're probably not in a lot of your markets. They tend to be in real true gateway, massive sized assets. I think long term it has absolutely no impact. I think it's almost irrelevant. It's a blip. When you invest in a place like China, you invest for a 10-year horizon with relatively low leverage just so you can stand the shocks. You need a pretty durable capital structure. And I think that unfortunately the Chinese, when they went around the world and did this buying spree, they actually didn't heed that particular advice, and they're massively over leveraged, and that will all be wound down. I don't think it'll have much impact on prices anywhere, to be honest.
Interesting. Because, certainly, at least the three of us have probably seen 3, maybe 4 cycles that we've been in. And since 2010, there's no question we've been running pretty much straight uphill. And every time, I'll give you a personal example. In October, I basically said, I'm smart enough not to be in stocks and bonds anymore, but that was the wrong move. So how do you feel we are in sort of this whole cycle? Does it just go on? What Andy was saying, it kind of looks like it just goes on, but I'm interested to see your thoughts on.
Well, I lived and worked in Japan for many years, and I was there when there was a massive deflation, significant NPLs, and folks like us made money hand over fist because of that deflation. And I think there's a lot of parallels between the United States and Japan right now. Clearly we have called 370 million people. They have 120 million. We're a lot more entrepreneurial. They're not. We have a lot more immigration, although that's changing. Japan has essentially no immigration, but broadly speaking, both were fueled by monetary and fiscal stimulus and ultra low interest rates for a very significantly long period of time. And if you look at Japan, what's happened is cap rates have hovered in the 2-3% range for a very, very long time. And foreigners like ourselves have made money there through infinitesimal cap rate compression and massive leverage. And asset prices have never really reflated. They're not. And I think what my prediction in the United States is there'll be a lot more pain than most people predict. That's just my particular view. I think that there will be a come to Jesus and that prices will reflect that and people will lose a fair amount of money. I like the clock, the Jones-Langley clock, all that. It all makes sense, but I do think there'll be pretty significant corrections in asset prices.
How much of your time do you spend in Asia versus the United States? Is it project driven? Is it opportunity driven? Do you have to spend a certain amount of time in different markets?
It's probably
other than personally liking Japan.
It's about half and half, maybe 2/3 U.S. now. In all candor, we see more opportunity to make better risk-adjusted returns in Asia. There's more opacity, there's more inefficiency. So for groups like us, we do structured credit deals in places like India and Thailand where we make meaningfully more money than we would make on a typical mezzanine loan in the United States. It's about 1,000 basis points difference for very similar levels of risk. So for my personal time, that's what excites me more. Here it's frankly much more difficult for guys like us to make money. It just is.
More competitors or just more money chasing the stuff here, or both?
Well, you have much more developed capital markets, so in terms of structured credit, mezzanine, much more difficult to do it here. In terms of the equity, we're a pretty big firm. We manage in about $275 billion of assets, but there's plenty of us. When you go to markets like India or Thailand or China, there are not many folks like us out there. There's the Blackstones of the world, there's ourselves, very few others. And so it's just simply more opaque and easier. The public markets are pretty developed there, but they don't concentrate the kind of ownership the way they do in the United States, with maybe the exception of Australia. That would be the only market that looks a lot like the United States.
Everyone talks about there's a lot of dry powder, particularly in the United States and other places. Does that ultimately extend the cycle? Because there's been so much money raised, especially like people like yourself, and as you mentioned, Blackstone and others, that it has to be placed. It has to be placed in very large-scale investments. Because a lot of the people in the room here will do business in, let's say, the 2 to 50 million range because they're more local in nature. But it seems like we always hear from the large institutions like yourself that you can't even look at things that are too small because the economies just don't make a whole lot of sense to buy something on a small. Are you doing the opposite, maybe?
No, we do. The last deal we did was in Morgantown, West Virginia, for $8 million. We bought a manufactured, home community. So I'm not sure that that's the case. I think that guys like us do look in secondary and tertiary markets. We own assets in, I don't want to be derogatory toward these markets by any means, but we own assets in Nashville. We own assets in Cincinnati.
Nashville's one of the hottest markets on the planet right now.
After we went there.
Right.
We're going to sell soon.
Yeah. We actually had some people that are sitting from Nashville in the room here today.
We have gone into secondary and tertiary markets. I think the key is that it's mostly been in the Sun Belt. It's mostly been where there's significant job growth and household formation. We're not a big suburban office buyer generally, but I don't think that you can say that there'll be a bifurcation between size. My personal view is that prices will compress everywhere. And regardless of whether there's a lot of dry powder, I mean, once markets start to compress, that dry powder gets really scared.
Interesting.
Interesting. Just to get a little bit political for a minute. I know, Jay, you were at MIPIM recently in France. If you can describe what that was like and what MIPIM is, and then follow up with Philip. What are people's viewpoints of our president, the stance that our president is taking with the tariffs? Just either you call it stability or instability, how people are focusing on America as an investment, and what foreign investors are looking at America. So Jay, if you want to talk a little bit about MIPIM and your impressions since you were there recently last week.
We, along with Andreas Krohn and others that are in this room, is our German partner, all of our Europeans were just recently at MIPIM, which is the largest European conference in commercial real estate. About 35,000 people convene on Cannes in March in the south of France in the winter. So the party atmosphere was still there, so that's always a good thing. But the tone as it relates to our president is, it depends who you're really talking to. There's some people that go, we don't care. You know, we're used to politicians that act like that, you know, in different countries, especially in Europe. Then occasionally you'll run across somebody that'll say to you, what's up with your president? What's up with your government? But in a certain regard, it's more of the tabloid interest than the actual interest. It's more of what they're reading in the paper. I actually had one direct conversation with an Italian that said, we're totally used to people like this. This is commonplace in where we're from. There really wasn't a lot of negativity because I think most people are still convinced they won't bet against the United States. They still believe that regardless of our president, or our Congress, that ultimately this will be sorted out. I didn't hear any conversation on the tariffs aspect. There really wasn't any, but keep in mind there weren't people that were having a lot of tariffs sent against them. And there was a huge American contingent at MIPIM talking to European investors to invest in the United States. So there didn't seem to be a lot of hesitancy to still look at the U.S. from what you're asking on a political side. I think it gets to some of the fundamentals, but it all is going to really depend on, I think as the taxes are a big change, whether you agree or disagree with the Congress, the president, et cetera. They're certainly fixing some of the things that are going on from a wealth point of view, and certainly from a real estate point of view, it's making it more returns on investment after tax are a little bit better. So I would say it's a little bit more on our television than the rest of the world really thinking it's a problem.
And Philip, what are your
I think it's
impressions?
indifference.
Indifference.
Yeah, care less. The Chinese get a kick out of it.
But they now have rulers for life, so that's a completely different change and something. That, speaking of this, could be interesting to see. Certainly the Chinese still own a high proportion of our debt, and I don't know if you've had any thought, or again, you might just say, what are your thoughts on that?
Well, I think it gets to the general instability. I mean, the difference between China and the United States, or Japan and the United States, is the United States debt is mostly externally owned and controlled, and most of the Asian countries, it's internal. I mean, China's debt is all internal. So, people talk about the massive NPLs and kind of capital problems that China has, and I would argue that they have a much easier way of dealing with their issues than the United States has. I mean, the closest country in Asia, in my opinion, to the United States is India. It's broadly speaking a democracy with the exception of a few areas. It's a significantly large entrepreneurial, well-educated workforce, and I would say that there it's as dysfunctional as the United States in many respects. And so it makes it much more difficult to invest in real estate in India than it does in China, despite the fact that most people would think it would be the opposite because you have English language and you have theoretically rule of law. But I don't mean to be pessimistic about the United States, but I think that the issues that the country faces politically are much more around inequality of wealth than they are anything else. And those are very, very destabilizing, and I think they'll be very destabilizing for a considerable period of time.
When Andy was talking a lot about disruptors, a lot of institutional real estate companies like yourself and others have been investing in disrupting companies. And I know you historically have had investments in different real estate firms. Are you looking at any disruptors, whether it's the real estate tech space, the fintech space, or operating companies that you would consider?
Yeah, we're not really, it's funny, we're really not that good at that in the sense that some firms do a lot more venture investing and we really don't. So we're probably not the best positioned. You know, we're a weird firm in the sense that we look for distress. We look for distress even when there's not much distress. We look for dislocation and we look for inefficiencies. We tend not to be a good investor in terms of like a WeWork.
Right.
We looked at WeWork when it had a $2 billion valuation, and our assessment was, well, Regus has been bankrupt about 3 times. It makes no sense. You know, they have mismatched assets and liabilities. You know, again, naively, we didn't dig into the numbers very much, but you know, you have an enterprise that basically has long-term liabilities and short-term assets.
You sound like someone I know really well that's sitting in this room. I'm glad to see that you now validated our chairman's thought on
You know,
WeWorks.
and I
100%.
toured a bunch of their assets,
Yep.
and you know, a phenomenal story. And then you see it's worth $16 billion. I mean, we looked at a company. I sat on the board of a company called Compass. I'm not sure if they're in Philadelphia. It's a residential brokerage, and I was the independent board member. It's a fascinating company. You know, it's a Harvard grad who worked at Goldman Sachs, and the guy who started 2 companies in Sydney, Australia. Very, very bright engineer. And their whole premise was they were going to have a broker-light residential brokerage, and they were going to start in New York. They were just going to do rentals, and they were going to disrupt Corcoran and Douglas Elliman and everyone else. And I went to the first board meeting and I said, this makes no sense. Like, you're going to have 1,000 brokers and you're going to do sales. You know, they said, no, you don't get it. Well, sure enough, that's what they did. You know, and they're just a brokerage and they have a valuation of like $2 billion. I mean, some of these things make no sense. And I think for a firm like ours, where we're so driven by fundamentals, it's hard to back these, quote, disruptors, because I think what's happened is you have these disruptors in valuation, but they haven't really disrupted anything so much yet, and time will tell.
Are you still invested in Realogy a little bit? Or?
No, we're
No,
not.
you're totally
No,
out of that.
no,
So
yeah.
would you, because that's interesting, because I know you were heavily invested in, and certainly they've been going through a lot of different changes on the residential side. They've actually been doing a lot of changes through their Coldwell Banker commercial and different changes. But what do you think about that? Let's say, you know, we are, a lot of the people in this room are in the commission brokerage business on the commercial side, but it'd be interesting to see, you kind of just said your thoughts on sort of Compass on the residential.
Well, I think there's a difference in earning your living that way versus trying to create massive enterprise value that way. And I think that's the disconnect. I think there's a need, you know, for folks like yours in secondary and tertiary markets where information is less than available. It's a very valuable resource. And people like us, we're looking for edge. You know, so all around the world, we're looking for markets. I can give you story after story of places where we've invested where the macro research was one thing, and as you got more granular, you found a completely different story, and we made money.
Right.
And I think there's a lot of value in that. And the question is, can you take something like a Compass or a WeWork and create a $25 billion enterprise? That's where I think there's a disconnect, personally.
Because one of the things that we always talk about, you know, we have 183 independent members across the globe, and there's well over 400 different offices, and sometimes these are first, second, third, or fourth generation real estate operators, brokers, owners in these local markets. Is that what you're saying, the expertise that makes the difference sometimes in
You have to understand, most people that do what we do, well, I mean, I don't mean to be disparaging about those slides before, but they take those slides and they take them to an investment committee and they say, we are going to do manufactured housing because the expected unlevered IRRs are 7%, and we're going to do data centers because it's 7.5%. And the bottom line is that there's no magic in that. I mean, we can all get that data and we can all do that. You know, in my opinion, where the money is made is in markets where people have extreme informational advantage. And it may be that they understand that demand for leases are much better than you may think. They may particularly know of an obsolete asset that can be repositioned. I mean, that's where folks like us make our money. We don't make our money in the macro assessment of, you know, buy defensive malls because you're going to earn a 3.5% IRR over the next 10 years unlevered. We would be out of business if we did that. So I think there's enormous value in the granular expertise, and that's what we look for in a lot of our operating partners. And we have guys in Florida that are real local sharpshooters. We do deals in Sarasota and Clearwater and Fort Lauderdale, and These are off-the-run transactions, smaller office buildings that, you know, we get leased up very quickly and sold at very good cap rates. You wouldn't get that kind of data from the macro. You would never do that kind of stuff.
We've got quite a few of those, so we can talk later when you mingle in the
That'd be
room,
great.
and quite a few of our
We can become your investment arm.
There you go. There you go. You know, one of the things that we always try to ask our guests, like yourself, when we have, is that, you know, 3 years, 5 years, 10 years in general, you know, because it's always interesting, you know, you've kind of touched on some of it, but what your thoughts are, what your outlook, what, you know, things like that.
I mean, my outlook is I'd like to see a massive dislocation in the next 5 years. Again, I think it would be good for you all. I mean, transaction volume will increase.
What is your 100% bet on what you, if you had a bet, what is going to cause that? Because I would thought the Russian devaluation would have done it. I thought the stock market.
I think it's something much more fundamental and simple. You know, when you look at the groups like ourselves and the Blackstones, and you know, when you talk about all that dry powder, when you look at the REITs, there's one thing they all have that is consistently in common. They're long-only purchasers. And so when you think about some of the firms that compete with us and ourselves, we raise more and more money, and we just put it out into real estate, and more, what are you hoping for? That values go up and up and up. Right. The second that turns, that's going to be massive devastation. And so I think that what turns it is just simply interest rates rising, cap rates starting to rise, you know, the affordability, which already is a problem. If household incomes don't rise commensurate, something has to give. I mean, our whole manufactured housing thesis, if you look at our average rent, I don't mean to get this specific, but I'll give you an example. You know, across our whole portfolio, we charge about $730 a month in average rent. In our markets, the average multifamily is about $1,100, and the average single-family front is $1,300. That's massive affordability differential. And we see the reason why our manufactured housing is doing so well, despite the fact that it's not the most glorious asset class, is because people can't simply afford the other types of living. That is unsustainable. I can take it more granular to the markets like New York. What's going to give? The change in the taxation, which that graph said was so 90% of the country is doing well. I'm not sure I agree with that statistic exactly, but the problem is in the other major markets like Illinois, Massachusetts, New York, New Jersey, and a bunch of other more democratic states, the impact is going to be massive, massive, and there's going to be a lot of wealth loss that's trapped in people's houses. The assumption that single-family houses keep rising at 3 or 4% compounded is fictitious. I mean, you know, how many 7-year and 10-1 arms are there out there when interest rates reset? People are going to be underwater. The same problem that happened in 07, 08 is about to happen again. And once that happens, I think you're going to see real estate prices weaken significantly. A lot of the foreign buyers are going to run for the doors. A lot of the domestic folks are going to have massive problems on their own balance sheets because they've gotten so disproportionately large so quickly. And to me, that's one of the reasons why the REITs are trading at discounts. I think it is a predictor, but I think that I would argue NAVs are starting to weaken faster.
So I think, as you know, our parent company is invested in the private and public REIT space.
I know
as
Andrew.
You know.
Yeah, I know Andrew.
And certainly others like Blackstone and Starwood. Be interested to get your thoughts on that space as it relates to the booming the age boomers and baby boomers. There you go.
There's certain folks like Andrew and Barry Sternlicht and others that have made money in every cycle. They've made money out of dislocations. You know, Andrew had reinvented himself twice. You know, I think I'd rather be a partner. Three times. I'd rather be his partner than a buyer of his. You know,
Mm-hmm.
But I think he's a perfect example of finding ways to make money. Mm-hmm. There's always ways to make money. I think that there will be easier ways to make money in the future once prices reset a bit. I think that it's just overall too buoyant, and people highlight, you know, President Trump as the impetus for some change. I actually don't think that's the case. I think regardless of whether he was president or not, that there will be asset price deflation. I just believe it. I see it in New York. I see it on the West Coast. I just see a correction.
Okay. Thought we would open it up, Fred, for a couple questions and to the audience. And I know our team has some microphones available, so we'll be more than happy to welcome a few questions to end our session with.
Now's not the time to be shy.
Exactly.
I guess we covered all the bases.
There we go. I
There you
think we
go.
have one over here.
Thank you. Paul Fulmer from NEI Commercial Partners in Lancaster, Pennsylvania, about 60 miles west of here. Can you tell me what your view is of where there will be growth, relative growth in gateway markets, primary markets, secondary markets, and tertiary markets? I was intrigued about your investment in Morgantown and how a specific asset class was very important. Do you see, as things change with the Amazon effect and things like that, the self-driving cars and so forth, how will that affect each of those different markets, please? Thank you.
Sure. I mean, I think we try to find demographic drivers that help. So, for example, senior housing, the demographics are pretty compelling. I mean, life expectancies are being expanded with the wealth effect. So you start with a base where there's a tailwind. You look at manufactured housing, like I discussed, there's a tailwind behind that. There's net negative supply and affordability is behind you. So I think that the key is, the chart I really liked is the effect of disruptors, and we look at that and all the retail investments we make in particular. I think the key is to try to find parts of the real estate ecosystem where the demographics coupled with the disruptors are kind of in your favor as much as humanly possible. The converse of that would be something like a suburban office, for example. My personal view is if you buy commoditized suburban office, regardless of self-driver cars, et cetera, is a very, very difficult investment to make money on in this particular period because TIs and leasing commissions are extraordinarily high, much higher than you'd face owning a manufactured housing community in a suburban market. And relative affordability, while it's there, there's just not much job growth per se. There just isn't. And so I think that you try to find the spaces where there is kind of discernible tailwind / lack of disruption. And I think that's the simplest way to invest right now. In a pure defensive standpoint, I would buy a lot of multifamily, regardless. I would buy infill, kind of gateway city, high quality multifamily, like a Simpson housing portfolio that one of our investors, state of Michigan, owns. I think that's extremely defensive. I would stay away from single family for rent. It's extraordinarily operationally intensive, and it's just a very difficult asset to maintain, to grow. You're taking massive market risk, and then on the exit, it's very difficult to exit. We have about a $400 million portfolio, and the expense to exit on a one-off basis is about 8.5%. It's very inefficient. So I would look for areas where enough of the tailwinds are in your favor. I hope that addressed the question somewhat.
Yes, sir.
Great, thank you. Bryce Custer on the Ohio River Corridor. You mentioned Morgantown, and again, that caught my attention. Any comments on China Energy's memorandum of understanding to invest $83 billion in the West Virginia infrastructure?
Oh, you're talking about the incoming Chinese investment into the States?
That's into the state of West Virginia for their energy sector, yes.
Yeah, I think outbound Chinese investment right now is probably not something I would necessarily bet on until it was finished, because there's so much uncertainty around getting capital out of the country. 3 years ago, 4 years ago, 2 years ago, it was very easy for Chinese corporates. And you have to understand, when any Chinese corporate is taking meaningful amounts of money out of the country, that's sanctioned by the government. That is essentially the government doing it. And that is pretty much on its head right now, both because of currency weakness and just the fear that the Chinese have overspent. So I would not, if you asked me 10 years ago, there's a great museum in Shanghai, and basically it mapped the exact progress of all of Shanghai for 25 years. And every single thing the government said they would do, they did. It's shocking. I mean, you would never have that in the United States, because by the time a government got around to building an overpass or a bridge, it could be 25 years. In China, it was like clockwork. I think right now there's this strange period of time where that dynamic is changing a little bit, particularly as it relates to outflows of capital.
Other questions? Bjorn? bring you the mic. Oh, sorry. Andy, go ahead.
Hi, Andrew Sample, NAI James E. Hansen. 2 weeks ago, I was in Vietnam. Last week, I was in Thailand. Unbelievable amount of construction. Cranes throughout Thailand, not as much as Vietnam. I heard your comment about investing in Thailand, and I was curious, does that have something to do with the different forms of government between those two countries?
Did you see the tower in Thailand called Mahanakan? It looks like a Lego.
The jigsaw puzzle?
Yeah.
Yeah, yes.
We have a $250 million investment in that building. We control that building. And, you know, Thailand is an interesting market. Thailand is, for 15 years, it has suffered like 20 exogenous and endogenous shocks. You know, 2 coups, terrorist attacks, Asia financial crisis, global financial crisis. It's insane how I can cite them. And we have this chart that maps the currency, the stock market, and the commercial property index over that 15-year period, and it's shocking how flat it is. Basically linear and upward sloping. And the reason is very interesting. Bangkok is now the most internationally tourist visited city in the world. It's got 35 million a year. Of that, 13 million are Chinese, about 1.5 million are Indian. Very little, it's about 300,000 from the United States. It's a fairly large European, particularly German, for untoward reasons. I'll tell you, when you see them on the flights on Emirates, you just don't want to look at the Germans. But needless to say, what Thailand has that's very interesting is it has a very internal financial system. There's very little external capital there. Very few money center banks, very few groups like ourselves. So you have a situation with a very robust GDP, a very, very robust economy that is extraordinarily inefficient given today's kind of world economic climate. And that's what's yielded a very interesting investment palette for us. There's a lot of distress there. You have a lot of undercapitalized hotels that have been owned by families for generations and generations and generations that are basically 1/4 market rates in terms of RevPAR. And guys like us come in and give those families capital to renovate and get a pretty extraordinary returns on that capital investment. So that's a market that's a perfect example of a market that people would not touch normally, and we found incredible opportunities there. I have about 20 people on the ground there in Bangkok.
I actually have a question. How many languages do you speak?
Barely one, as you could tell. Barely one.
With all the time you've spent in the Asia Pacific?
I took many years of Japanese. I became pretty proficient, but that was 01, 02, 03, 04.
Okay.
It's long gone. Fortunately, I have people that are both smarter and more eloquent and speak those languages.
Me too. That's why we have Mauro Keller Sarmiento, who's our head of international. Exactly. I think we have a question right here.
Yes, you mentioned many very interesting things about including China.
Oh, is he German?
Yes, I'm sorry.
He's
and worse.
He's from Shanghai.
Worse than that. I'm one of the Germans living in Asia, and I apologize. I apologize.
He lives in China.
This is a setup.
No. He lives in China. Andreas will ask the next question, but that's okay.
But I've never seen you on the Emirates flight into Bangkok.
No, not Bangkok. So the things you mentioned, I think, it's very impressive to see a Westerner finally understand Asia, because Wall Street Journal and Forbes and all these guys always get it wrong. But when you speak about e-commerce, I think Asia is a bit on the forefront, like Japan, Korea, China, and there it's more like 20-30% e-commerce, and then not 10. So don't you think like in another few years that would be 10, 20, 30% in the US as well?
Well, I would argue that if you look at a market like take China, for example, the e-commerce adoption is very quick, but partly that's driven by the fact that they never really had terrific organized retail in the first place. There was never a culture of type A defensive malls in major cities. Doesn't exist. In fact, many of the REITs went out there in the kind of mid-2000s. So Taubman, Simon, they all went out there. The Buxbaums, they all failed because retail was so underexploited and so unknown that no one really understood what formats would work there. So I think that there's a faster adoption. It's happening much faster there than India, frankly. But and the reason why I know a little bit about this space is we own an outlet mall in Suzhou, an hour outside of Shanghai. And just getting the Chinese consumer to understand the value proposition is extraordinarily difficult. tenanting of that asset, we're like 90% leased now. It's called Value Retail Suzhou. There's also one in Shanghai by Disney World. Is shocking. The productivity of those assets are much lower than we would have thought. If anyone's familiar with the UK, we have an asset there that generates about $3,000 a square foot. In Shanghai, we're about $600. It's 1/5 the productivity. And a lot of it has to do with educating the consumer. I think that the flip side of what's happened in a place like China, now a little bit more so in India, is that the investment into logistics is wildly growing because, and it's a great example of a hot sector. I don't mean to be such a negative, prophetic person, but the hottest sector probably in the world right now is China industrial logistics. That would be the hottest sector I see anywhere in the world. And the fact of the matter is we don't believe you can sustainably make money, right? The statistics are there. It's completely underpenetrated by numbers that are shocking. A good example is a city called Chongqing, which many of you have probably never heard of. It's got 27 odd million people. There's less industrial there than in Atlanta, Georgia, but mind-blowingly less. So there's certainly a need. The problem is it's very difficult to get the land at efficient prices to build to good yields on cost. And so now what's happened is yields on cost have compressed from like 9% to 6.5%. So the spread is de minimis. It's like a 100 basis point spread. And so I think that the answer is, yeah, e-commerce was adapted quicker there, but I don't think that is a forerunner to what's going to happen in the United States by any means.
Quick question, when you look at the land costs up in northern Jersey, it's over $1 million an acre for a warehouse building. Similar in LA and the Inland Empire, you can't find land. So how does that work in your model?
But that's why industrial is one of the hottest asset classes in the United States. But it's not.
How can the rents sustain it?
It's hard. It's not sustainable. Ultimately, it's not. In my opinion, it's not sustainable. Which is why we're a net seller. We've sold assets in Atlanta. We've sold industrial in Chicago. We're just selling 7 assets around the country. We own those assets like an 8.5 cap, and we're selling it like 570, 580 caps.
And is that why SIVA leases instead of owns? SIVA Logistics? That's why SIVA Logistics leases instead of owns, I guess.
Yeah, it's very difficult. Again, we're in the business of making very high returns, so we have to look for specific pockets, and then we exit right when we think that there's a hot asset class or it's overheated. So I think that, I don't know, I don't mean to be so negative on the charts because they're fascinating. I find them fascinating. We look at them, we do study them, but I think that there's a big gap between, in practice, finding places to make money. And I think you guys have great advantages because you have competitive information. CBRE probably doesn't cover some of your markets as well as you know them. Right? In Asia, that's how we make our money. If you're from Shanghai, we invest in something we call flex office, hybrid industrial office in Shanghai. We're buying obsolete manufacturing facilities and turning them into kind of light manufacturing, wholesale, and an office. We're building to 10 yields. Wow. We had to hire Jones Lang LaSalle to do a 200-page report. They never heard the asset class. We went out to raise money for this, and people were like, oh, we never heard of it. We can't do it. You can't imagine. Investor after investor said, no, we won't touch it with you. Until we had our 200-page report, we did our first 9 deals. It's so obvious to me. And then finally, one co-investor said, we'll put in $100 million. I mean, for a year, people thought we were nuts. But that's how guys like us make money. And it's good to be nuts at first. We don't make our money seeing something like WeWork and saying, this is the greatest thing, everyone else loves it, we'll do it too. To me, that's the fastest way to lose money. I mean, that's just my personal opinion.
I'm so happy you said it's good to be nuts because I think a lot of people sometimes think when they listen to me that I'm nuts, but that's wonderful. Thanks. I think we have a question, Russ, in the back.
Yes.
Hopefully it's not a German.
No, it's a Brazilian, sorry. I'm Marcelo from NAI Brazil. Quick question. Why not Brazil? Why not South America? I have Colombia, Argentina, Peru, Chile, and Brazil is a brick anyway. Thank you.
Sure. There's an easy answer and a more complicated answer. The first answer is that we go where we think we have a competitive, sustainable advantage. And so in a market like Thailand, I really am convinced we do. In markets like Argentina, Brazil, et cetera, we really don't. As a firm, we don't have that footprint. And then individually, my team and I, we just don't. That's the simple answer. The more complicated answer is we hedge all of our international investments. And so for us to hedge, the currency is extraordinarily inefficient. And so even if we found a deal that we liked and it made sense, and we have found a few in Argentina that sort of piqued our interest, when you really run the numbers and you look at the hedged returns, it doesn't really stand well against the hedging and the returns that we expect in some of the other markets we do around the world. But I think that to the extent we could find a sustainable advantage or we had some kind of a unique edge, we would look at it more carefully and we'd probably push the envelope more.
Okay, now you have our German partner, Andreas Krohn. He's
Oh,
going to
gosh.
ask a question. And
by the way,
he's a great guy, by the way.
When you go to Thailand and stay at the Edition, it will be open in 2 months.
But you will not see me on an Emirates flight. I fly Lufthansa. That's more convenient. Yeah, Andreas from NAI Apollo. You recently invested in a German firm, Demire. We were involved in that deal from the beginning, from last year on as well. So, what is your views on Germany? Would you stop directly investing into buildings and properties and shifting more towards investments in firms? And then, what's your general outlook for real estate in Europe in the coming 2 years?
I think the outlook is positive. I think the reason why we're more and more looking for platforms so we can get scale. That's really the reason for the platform investment and grow with a management team that we like. It really wasn't those kinds of investments are not specifically because we'll only exclusively do a platform investment. I think we have a colleague of mine in London that is of German descent, loves Germany. We've done a lot there over the last 5 years. I think we'll continue to, both at the asset level and at the enterprise level. Of all the markets that we operate in Europe, that's probably our favored market for the mid to long term. More so than the UK, certainly more so than Ireland and Italy where we've operated, and Spain. We haven't been terribly successful in Spain.
Well, I want to really thank both Harold and Fred for engaging and getting Phil. Thank you for joining us this morning. This was a wonderful conversation that candidly has been global in the nature, and really appreciate your background and participating today. Thank you so much.
Thank you. Thank you. Thanks a lot. It was nice meeting you.
Thank you for coming.
Play golf.
Hope you enjoyed the program.
Good luck in your tournament.